Welcome back to the Deep Dive. Today we are opening up the pantry, so to speak. We're cutting into a real American institution, Hormel Foods Corporation, ticker HRL.
That's right.
Our mission here is to take a good, hard look at this, well, iconic food company. You know, Spam, Skippy, the list goes on. And figure out if its really resilient, century-old business model can actually withstand what's happening now. These massive twin shocks, modern inflation, and maybe more importantly, the rise of really high-quality private label brands.
Yeah, it's a fascinating situation because Hormel isn't just like any big food company. It's a financial stalwart, a really big name.
Right.
I mean, think about it. Founded way back in 1891, Austin, Minnesota. Now they're global, around $12 billion in revenue, operating in over 80 countries.
Huge footprint.
But the real headline, especially for long-term investors, the thing that gives Hormel that elevated reputation, it's that status as a dividend aristocrat.
Yeah, that's key.
59 years, consecutive years of increasing the dividend. That tells you something pretty profound about their underlying consistency, their cash flow generation over decades.
That is the stability, isn't it? Nearly 6 decades. That's a rare thing in any industry.
It really is.
But, when we look at the source material, the story changes, drastically after 2022. The period covering fiscal 22 through 25, it's consistently described using words like unprecedented. Unprecedented macroeconomic challenges, industry-specific challenges.
Precisely. So you have this incredibly resilient, almost defensive business model suddenly caught in this severely pressured environment. The market just shifted, maybe faster than they could really absorb.
Yeah.
So the core tension right now, and I think the key question for you, the listener, is basically this. Can Hormel's huge company-wide transform and modernize, they call it T&M program, can I actually restore their margins against, historic commodity inflation, maybe the bigger threat, this structural long-term thing with retailers pushing really good private label stuff?
Yeah. So they're like a defensive giant forced onto the offensive.
Exactly. And the margin for error, well, it feels like it's shrinking.
Okay, let's unpack this. Let's start with the foundation, understand the field of battle, so to speak. Hormel responded to these early pressures, right? They realigned their structure in fiscal 23, something called Go FWD.
Yep, the Go FWD initiative. It was about simplifying their focus, dividing operations into 3 clear segments: retail, food service, and international.
Okay.
And while that realignment was really about internal efficiency, streamlining things, the strength of Hormel has always rested on its brands. The brand equity.
That's their moat.
That's their primary competitive advantage, yeah. A portfolio of over 30 really powerful brands. And these aren't just, old legacy names. Many hold the number 1 or number 2 spot in their category.
Impressive.
But, as you said, the performance of those 3 segments, well, it's diverged pretty dramatically. It really shows where their traditional strengths still hold up and where they're acutely vulnerable now.
Okay, let's start with the biggest one, and frankly, the most volatile: retail. This is the core, right? Selling directly to us, the U.S. consumers. Grocery stores, mass merch, club stores.
All the usual channels.
And the portfolio here is wide. Everything from those, classic shelf-stable things like Spam and Skippy peanut butter, right next to the refrigerated stuff, the higher value things like Hormel Black Label bacon.
And volatile might be an understatement for what we've seen lately. I mean, this segment really took the brunt of the cost hikes and the consumer pulling back. We saw, significant softness in fiscal 24. It culminated in the fourth quarter where volume actually fell pretty steeply, like 6%.
Ouch.
Yeah, and that dragged down net sales, too. That's a major hit when it happens to your biggest segment.
But then there were signs of life. Fiscal 25, Q3, things looked better.
They did. The rebound was strong, actually. Volume and net sales both popped up by a solid 5%.
Okay, so what drove that? Was it broad-based?
Well, it was pretty specific, actually. Driven by strong demand in Turkey. The Jennie-O business, which was recovering from its own massive supply problems, we'll get to that, plus performance from the Planters Nuts business they bought, and interestingly, continued global strength in Spam.
Spam just keeps going.
It really does. But here's the crucial caveat, right? Despite that nice rebound, retail is still their major point of structural weakness. Why? Because it's the most directly exposed to those core threats we talked about. The private label competition, and just consumers relentlessly looking for value.
Okay, so if retail is the, let's say, vulnerable core, Then the food service segment, that's often called the engine of stable, profitable growth. Why is that?
Because the whole dynamic is different there. Food service provides these highly specialized branded solutions. Think prepared meats, culinary ingredients, customized sauces. They sell these to big commercial operators.
Yeah.
Restaurants, hotels, schools, hospitals.
Right, not individual shoppers. Yeah.
Exactly. And this segment has been just a consistent source of outperformance. It regularly beats the broader industry growth rates.
So what's the secret sauce there? What creates that durable moat that retail just doesn't seem to have?
Well, it's widely attributed to their renowned direct selling organization. And this is where the details really matter, I think. They aren't just, dropping off cases of bacon. They're delivering solutions-based products. It's consultative selling.
Okay, give me an example.
Sure. Think about a restaurant chain. Maybe they're facing really bad labor shortages, which is common. Hormel comes in and offers, say, pre-prepped sous vide proteins or customizable, ready-to-use ingredients, things that dramatically cut down labor time and menu complexity for that operator.
Ah, so they're solving a business problem, not just selling food.
Precisely.
Yeah.
They're solving a pain point for the client.
That makes sense. It sounds like a much higher touch, stickier kind of relationship.
Exactly. And because of that relationship-driven approach, they're not just competing on price against some generic house brand. They become kind of integrated into the client's operations.
Right.
And that differentiation. That's why the segment delivered a really robust 7% jump in organic net sales in Q3 of fiscal 25. Even while the rest of the business was wrestling with all that commodity volatility, it really proves the model's resilience there. Hashtag 1.3 brand portfolio spotlight and international recovery.
Okay, let's quickly touch on international. That's been more of a recovery story, hasn't it? Struggled a bit, especially with China in fiscal 23.
Yeah, China was soft, and that dragged the whole segment down. But the turnaround data since then, it's pretty spectacular.
That's spectacular.
Well, segment profit surged, get this, 184% in the fourth quarter of fiscal 24. Yeah. That was driven by a strong rebound in China, plus significantly better export margins across the board. And that momentum has kept going. Net sales grew 6% in Q3 of fiscal 25, heavily driven, again, by SPAM exports, especially to places like South Korea, Asia Pacific, where the brand has this, deep cultural resonance.
And they're putting money behind this, right? Investing strategically.
Yes, definitely. They're focusing investments on capacity, distribution expansion, particularly in key emerging markets. Think Philippines, Indonesia. These are markets where consumers are culturally receptive to their core proteins. And they represent, significant long-term growth runways, which is vital when your core U.S. retail market is kind of struggling.
Okay, so structurally, we've got this bedrock of iconic pantry staples, spam, skip, eat anymore, stuff people buy pretty much no matter what.
The defensive base.
Right. And a robust, high-margin food service segment. And this growth platform in snacking, boosted by Planters, brands like Holy Guacamole, it sounds like a fortress on paper.
It does.
But something clearly broke. Which brings us to the brutal reality. What actually caused that sudden kind of shocking margin collapse we saw?
Yeah, what broke the model? It really was a perfect storm, external pressures just hitting their highly centralized U.S. supply chain all at once, and the financial impact. Immediate, severe.
How bad are we talking?
Well, look at the gross margin. It contracted from 17.4% in fiscal 22 down to 16.5% in fiscal 23. That's a big drop for a company like Hormel. And it's why management actually used the word disappointing, which is rare for them, when talking about their full-year earnings.
Okay, so what were the absolute biggest cost drivers? What pushed those margins down so hard?
It was just a steep, relentless rise in commodity input costs, and it hit their core proteins the hardest. Pork, beef, turkey. This wasn't just general background inflation. We have specific, painful numbers.
Like what?
In Q3 of fiscal 25, they were still grappling with huge year-over-year increases. Pork bellies, think bacon, up roughly 30%. Pork trim, which goes into tons of prepared products, up around 20%. Yeah. And all this happened while beef prices stayed near record highs for pretty much the entire cycle.
That's just a massive, unavoidable hit to their cost of goods sold. And I guess that pressure gets magnified by how the industry works, right? Hormel faces this pricing lag, especially in retail.
Absolutely. That's a critical point. They pay those high commodity costs immediately, like this quarter. But their contracts with the big retailers mean actually getting price increases onto the shelf can take anywhere from 60, maybe even up to 90 days.
3 months.
Yeah. So that gap during a time when inflation is accelerating rapidly, it's basically a guaranteed margin squeeze. The profit just vanishes between buying the raw pork and selling the finished bacon or whatever.
Okay, so runaway inflation wasn't enough. They also dealt with something totally different, a devastating operational shock. Avian flu.
Yes, HPAI. Highly pathogenic avian influenza. This started back in March 2022, and it just absolutely devastated their Jennie-O turkey business. This wasn't, a slow burn. It meant mass depopulation of turkey flocks, a huge operational crisis.
How bad was the impact specifically on Hormel's supply chain?
Well, the sources say it was a primary driver of their fiscal 23 earnings decline. It really shows the risk of animal disease in this whole sector. The loss of birds, the supply constraints. It reduced their commodity turkey volumes by, wait for it, 80%. 80 at the peak of the disruption.
80%.
Yeah. I mean, imagine one of your major protein segments losing 4/5 of its supply almost overnight. The impact on production, planning, pricing, revenue, it's just catastrophic. Recovering from that kind of systemic shock, it takes years, not months.
Okay, so soaring costs, a crippled supply chain. And now we have to talk about the big one, the long-term structural threat that kind of makes this whole crisis different, the retail gauntlet. Specifically, the rise of high-quality private label. This isn't just cyclical, is it? It feels like a permanent shift.
I think that's right. This is probably the existential challenge for Hormel's traditional brand equity model, especially in retail. Private label.
Yeah.
It's just not the cheap bottom shelf stuff anymore.
Right.
Its market share hit almost 21% of total U.S. grocery unit sales in 2023. And analysts think it could climb as high as 30% by 2033.
A third of the market, nearly.
Yeah. But here's the statistic that's like a dagger to the heart for branded goods companies. 83% of consumers now explicitly say they believe the quality of private brand products is equal to or superior to national brands.
Wow. Okay, that one number, it basically undermines the whole premise of Hormel's retail business, doesn't it? If I, as a consumer, don't see a quality difference between Spam and the store brand luncheon meat, why am I going to pay the premium?
Exactly. The brand moat just collapses into a simple price war. And that's a war Hormel is structurally kind of disadvantaged in. Their supply chain is built for branded, value-added processing, right? Not for mass market cost efficiency like a retailer's private label operation. They just don't have the margin to compete at that lower tier without absolutely killing their own profitability.
And this connects directly to the second big structural headwind, retailer consolidation. All that power concentrating. We see the proposed Kroger-Albertsons merger. As retailers get bigger, their buying power is immense. They can really squeeze suppliers like Hormel.
Oh, that concentration is terrifying if you're a supplier. Look at the data. Even back in 2019, the top 20 U.S. food retailers already controlled 65% of total food sales.
2/3, basically.
Yeah, and it's higher now. So when you're sitting across the table from a customer who controls that much shelf space, you have almost zero leverage to push back on pricing, on promotional demands, on inventory terms.
But the most complicated part, I think, is what you call the customer as competitor dynamic. This feels like the real game changer. The retailers aren't just powerful customers anymore. They're actively trying to replace Hormel's products with their own.
That is the structural nightmare scenario.
Yeah.
Retailers like Walmart with Great Value, Costco with Kirkland's Signature, they've become incredibly sophisticated brand managers themselves.
So?
They're using their own shopper data mountains of it to see which categories are most profitable. Then they develop and aggressively promote their own house brands to compete directly with Hormel's stuff, often placing it right next to the national brand on the shelf.
And what does that do to Hormel's ability to charge more for, say, black label bacon?
It structurally limits it, almost crushes it sometimes. Why? Because the retailer makes a much higher margin selling their own private label product than they do selling Hormel's product.
Right, makes sense.
So naturally, they dedicate better shelf space, better promotions, better point-of-sale marketing to their own brands. It means Hormel has to constantly justify its price, its brand value, not just against, traditional competitors like Conagra or General Mills, but against the very company buying their products.
Wow.
It forces Hormel to rely heavily on things like Spam's unique, maybe non-replicable flavor or Skippy's decades of trust, because generic bacon or generic nuts, those are now seen as extremely viable alternatives by many shoppers.
That is just a brutal assessment of the environment they're operating in. So, okay, Hormel can't just sit back and wait for commodity costs to fall. They have to actively solve this structural vulnerability, which requires a massive internal shift. Bringing us to Section 3, the strategic counteroffensive.
Right. And Hormel's big response is this Transform and Modernize initiative, the T&M program. This is like their central pillar for fighting back, restoring profitability, trying to offset all those external pressures internally.
Yeah, T&M is basically everything for them right now. It builds on some earlier, maybe smaller initiatives like One Supply Chain, but it takes the scope to a whole new level. It's designed to streamline operations, cut waste, centralize functions, basically create significant internal cost efficiencies to give them back the margin that inflation and private label are just eating away.
Let's talk specifics. Financial goals. This isn't just some abstract idea, right? It's tied to concrete savings targets. It absolutely has to be. T&M delivered an initial $75 million in operating income benefits in fiscal 24. Okay, that's a start. But the big number everyone's watching is the target for this current year, fiscal 25. Management is guiding for an incremental $100 million to $150 million in benefit.
Okay, on top of the $75 million.
Exactly. And the ultimate goal is to get to $250 million in annualized savings from the program by fiscal 26. Management has been crystal clear on investor calls, executing T&M. That is the single most critical factor for their near-term earnings. If they miss these targets, well, the market will likely punish the stock pretty hard.
So operationally, what does this transformation actually look like? You mentioned cost reduction, supply chain centralization, portfolio simplification.
Yeah, supply chain centralization means moving away from that old decentralized model where, each brand or facility kind of did its own thing. They're standardizing how they buy stuff, simplifying logistics, streamlining manufacturing to really leverage their scale.
Makes sense.
Okay.
And portfolio simplification.
That means taking a really hard, ruthless look at which products, which SKUs, stock keeping units, are actually draining resources, cutting those lower margin, higher complexity items. This should improve overall efficiency and lets them focus capacity on the things that are actually growing and have higher value. Hashtag 3.2 portfolio shaping and investment.
And part of that simplification involves, well, smartening up what they actually own, right? They seem to be actively reducing exposure to the really volatile commodity markets.
That's a key piece, yes. The strategic divestitures are critical signals, the clearest one. Selling off their last company-owned farm operation.
What does that signal?
It's a direct move away from the massive risk and volatility that comes with live animal markets, right? You're exposed to disease, feed costs, huge price swings. This is a pivot towards the relative stability and hopefully higher margins of pure value-added processing. Less farming, more food making.
Okay. Now, speaking of the portfolio, the Planters acquisition back in 2021, that was supposed to be a huge growth engine in snacking, but it sounds like it hit some serious snags.
It did. And this really highlights how difficult integrating massive acquisitions can be operationally. Planters faced acute challenges, primarily at their big Suffolk, Virginia manufacturing plant. There were production disruptions, efficiency problems, logistical bottlenecks. It really negatively impacted their performance and, critically, their service levels through fiscal 24.
What do you mean by service levels?
It basically means they couldn't get the nuts, onto the store shelves reliably when the retailers wanted it, which you can imagine further strains those already tense retailer relationships and kind of undermines the whole growth story for the acquisition itself. Not good.
Okay, so acquisitions bring risk, but their internal innovation, their R&D, that seems to be doing okay.
Yeah, the R&D team seems to be compensating somewhat. They're focusing heavily on convenience and premiumization, on those areas where maybe they can still justify a price premium over a private label.
Any examples?
Sure. Successful launches they've highlighted include things like Hormel Flash 180, that's a sous vide chicken product, and their specialty Hormel ribbon pepperoni for pizzas. Apparently, those exceeded projections. They estimate innovation contributed about a 140 basis point increase to net sales in fiscal 24.
Okay, so that's real organic growth.
Right. It's creating new categories or niches where maybe the private label guys haven't caught up yet.
And they're backing this strategy with real money, right? Capital expenditures seem pretty robust. They aren't just cutting costs everywhere.
Absolutely not. Guided CapEx is between $275 million and $300 million for fiscal 25. And this tells you exactly where their priorities lie. They're expanding capacity for the high-growth, value-added stuff. Fire-braised meats, Applegate, their big natural and organic brand. And they're investing heavily overseas, particularly a major expansion at their Jiaxing facility in China. It reinforces that idea that food service and international are really seen as the future growth drivers. Hashtag 3.3 leadership transition.
Now, a big transformation like this, it really needs seamless leadership. Yet, We saw a pretty significant change right at the top recently.
Yeah, a big shift just this past June 2025. They promoted John Gingo to president, but maybe more critically, the former chairman and CEO Jeffrey Ettinger actually returned to serve as interim chief executive officer.
Edinger. He was there during a pretty successful period, wasn't he?
He was. He led the company through a long stretch of successful growth. So his return definitely provides a steady, experienced, and frankly highly familiar hand on the tiller during this really critical T&M execution phase, seen as a positive for stability.
But okay, bringing back a former CEO, even a popular one, doesn't that introduce a layer of uncertainty? Like, who's the long-term leader right when they need maximum focus?
It absolutely does. That's the flip side. While Ettinger brings immediate stability, the transition means the company is currently without a permanent, long-term leader designated to steer the ship beyond this transformation phase. That uncertainty remains until a permanent CEO is named. The market needs to see that the momentum behind T&M will continue, regardless of who's ultimately in charge, and that the board has a clear succession plan, which is currently kind of paused by this interim appointment.
Okay, so that brings us from the strategy and execution back to the hard numbers. They've got this massive cost program, but what's the underlying financial strength that lets them even attempt this? We need to look at Section 4, the financial foundation.
Right, and the financial foundation. This is really Hormel's trump card. It's the buffer, the cushion that allows them to absorb shocks like inflation and avian flu without just collapsing. You see this interesting paradox in their recent results. Really volatile earnings, but sitting right alongside very robust cash generation.
Okay, let's look at sales and earnings first. How did those hold up?
Well, total net sales, despite all the chaos, actually stayed relatively stable around the $12 billion mark. It was $12.5 billion in fiscal 22, down a bit to $11.9 billion in fiscal 24. So top line held okay. But the earnings cycle, clearly at a low point. Diluted EPS was $1.47 in fiscal 24. Compare that to $1.82 back in fiscal 22.
That's a noticeable drop.
It is. And the message from management is consistent. They say this decline is pretty much purely driven by external factors, those high commodity costs, and the HPI crisis hitting Genio.
Okay, but the real story, you're saying, is their ability to generate cash, regardless of what the GAAP earnings number says. This is where the balance sheet strength comes in.
Yeah, the cash flow resilience is pretty exceptional, actually. Operating cash flow hit a record $1.3 billion in fiscal 2024. Now, this is a critical metric because it significantly beat their reported net income, which was only $805 million.
So almost a $500 million difference.
Right. And that divergence, it's proof of strong earnings quality. It also shows really effective working capital management. For instance, they managed to cut inventory levels by over $100 million that year. That's converting idle capital sitting in warehouses into powerful operational cash.
And that cash flow strength.
Yeah.
That's the shield protecting their core identity, right? The dividend. That 59-year streak of increases feels almost non-negotiable for them.
It really is the cornerstone of their whole shareholder return policy. They absolutely understand that their valuation, their investor base, it relies heavily on that consistency. Even with earnings being flat to down over the last couple of years, they still approved a 3% dividend increase in November 2024, raised the annual payout to $1.16 per share.
That commitment really speaks volumes, doesn't it? Shows confidence in future cash flow, even if the immediate earnings recovery isn't there yet.
It does.
But I have to push back a little here. That period of soft earnings, it must have pushed the payout ratio higher, right? Based on that fiscal 24 adjusted EPS, the ratio looks like it's up around 73%. Isn't that kind of high? Doesn't that suggest the dividend is now being protected more by cash flow and the balance sheet than by actual growing earnings?
That's a really crucial point, and you're right to flag the elevation. Normally, yeah, a payout ratio near 73% would be a definite concern. However, because their cash flow generation is so strong and so much higher than net income right now, the market seems to view that high ratio as manageable.
Okay.
But it definitely comes at a cost. It severely limits their ability to deliver aggressive dividend growth. They're essentially choosing to prioritize the streak, keeping those 59 years going over the rate of growth, at least until T&M really delivers that promised margin expansion and earnings start accelerating again. They're protecting the payment, even if it means smaller increases for now. Hashtag tagged 4.3 conservative balance sheet comparison.
Let's put this financial discipline in context. How does Hormel stack up against its competitors, its peers, in terms of financial risk?
This is where Hormel really stands out. They maintain, by far, the most conservative balance sheet among all the major food peers. They've been actively paying down debt, lowered it from $3.3 billion down to $2.9 billion by fiscal 24. But the simplest way to see their strength is just looking at the debt-to-equity ratio. It measures leverage.
Okay, give us the comparison. How does Hormel look versus the others?
Hormel is sitting at an astonishingly low debt-to-equity ratio of about 35%. 35. Now listen to their key competitors. Tyson Foods, 53%, Conagra, leveraged up to 93%, and General Mills, 141%.
Wow, that gap is enormous. 141% for General Mills versus 35% for Hormel.
It's huge. It basically means Hormel has almost 4 times the financial flexibility of a company like General Mills. Their low debt, combined with that strong cash flow, it means their overall financial risk profile is substantially lower than their entire peer group.
That's significant.
It really is. That balance sheet strength is the ultimate buffer. It lets them execute this massive T&M transformation, absorb commodity swings, keep paying the dividend, and still have dry powder for potential M&A without ever really facing a liquidity crunch. That structural conservatism, it often gets overlooked when people just focus on the quarter-to-quarter earnings volatility.
That might be the most profound insight here. They genuinely have the resources to survive a long fight if needed.
Yeah. Okay. So we have this high-quality, financially secure company facing, temporary, but also some immense structural challenges. Let's try and synthesize this in Section 5. What's the outlook? What's the investment case look like now? How's the market actually valuing Hormel today?
Well, the market seems to be pricing Hormel as exactly what it is, a high-quality name that's currently under severe duress. Their trailing 12-month PE ratio is around 17.8x. Now, okay, that trades at a massive premium to the general food industry average, which is way down around 7.6x.
But it's pretty much in line with the broader consumer staples sector average, so that PE premium, it reflects the market recognizing their stability, the brand quality, and that low financial risk we just talked about. They get credit for the balance sheet.
But the recent stock price pressure, it does have a silver lining for income investors, doesn't it?
Absolutely. The stock price being down has pushed their dividend yield up to about 4.7%, which is near a multi-decade high for Hormel. So for investors who are focused on stable, relatively safe income, that high yield offers pretty significant compensation for dealing with the near-term operational uncertainty.
So the overall case is kind of a show-me story.
Exactly. It's priced based on its quality reputation, but getting a substantial re-rating, a higher multiple, that's going to require tangible proof that the T&M initiative is really working, restoring margins, and getting volumes moving again. Hashtag tag 5.2 investment risk assessment.
Okay, what are the key risks? What could actually derail this recovery story?
I'd say there are 2 primary business risks. First, ongoing commodity price volatility, especially pork bellies and trim. If those prices surge higher again, it could just wipe out the savings from the T&M program, like running hard just to stand still. Second, that structural shift toward private label. If private label really does hit 30% penetration, and if consumers continue to see the quality as equal or better, Hormel's premium pricing power in retail could be permanently damaged no matter how efficient they get internally.
And we can't forget the operational risks inherent in this business either.
Right. We saw what HPI did. The risk of animal disease recurrence is just a constant threat to Jennie-O and the whole protein supply chain. And finally, customer concentration. That's a big vulnerability. We know Walmart and its affiliates account for a huge chunk of their North American retail sales. If Hormel were to somehow lose favor or just lose significant shelf space with 1 or 2 of those giant retailers, the financial hit would be instant and severe. Especially since, for the end consumer buying bacon or peanut butter, switching costs are basically zero. Hashtag 5.3 critical monitoring factors for the learner.
Okay, so for you, the listener, wanting to track this story in real time, what are the absolute critical things to watch in the coming quarters? What should be on the checklist?
Okay, number 1, absolutely watch the margin trajectory. You need to see sequential quarter-over-quarter and sustained year-over-year expansion, both gross margin and operating margin. That's the clearest signal T&M is working and they're getting back some of that pricing power.
Makes sense. Number 2.
T&M execution. Track their progress religiously against that big target. The $100 million to $150 million in incremental savings for fiscal 25. Did they hit it? Did they beat it? Did they miss? This is the promised land for near-term earnings recovery. Missing it pushes the whole timeline out.
Got it. Third.
Third, look for a return to positive and, crucially, sustained volume growth in the retail segment. Not just one a good quarter bouncing back, consistent positive volume. That's the proof their core brands are still actually winning that shelf space war against the tough private label competition.
Okay. And finally,
Finally, just keep an eye on commodity costs. If market prices for key inputs like pork bellies suddenly moderate or even fall, that could provide a massive kind of unearned but very welcome tailwind to their profitability. It could accelerate the margin recovery even faster than T&M alone. So wrapping this up, it's been a deep dive into a really solid company facing, well, a generational challenge. Hormel clearly has the financial strength, that amazing cash flow, the strong balance sheet. It has enduring brand equity. But that core retail segment, it faces this fundamental structural issue. The customer, the retailer, has truly become the competitor, and they're trying to solve what looks like a permanent marketplace problem with essentially a temporary internal efficiency program via T&M. Will it be enough?
It really makes you wonder where their core identity, their future strength, lies moving forward. So here's our final provocative thought for you to chew on. We know these iconic, maybe irreplaceable brands like Spam and Skippy are fundamental to Hormel's value. But if the retail environment is now permanently defined by concentrated retailer power and really good private label alternatives, does the future of Hormel Foods ultimately rely more on that food service segment? The differentiated high-touch sales model that seems truly defensible. Does that need to become the dominant driver of the business? Is defending the brand on the grocery aisle simply not sufficient anymore? Maybe the future is less about winning the aisle war with Spam and more about solving labor problems for restaurants? Something to think about.